Hi everybody, welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 125, we're going to talk about a new state and local income tax workaround for pass-through entities which may be coming down the pike. It's in the process, but it's not quite set in stone that you can use this yet, and we'll see why. But as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, when I say salt, what I mean is not a seasoning that you use at the dinner table, but instead state and local tax. There's a huge element of tax law that deals with state and local tax because you can't just look at federal tax myopically. Now, in the past, taxpayers have typically been given an income tax deduction for their state and local taxes that are paid during the year, both on the personal side and on the business side. However, under the Tax Cuts and Jobs Act of 2017, this changed for tax years through 2025. Because the SALT deduction for individuals was limited to $10,000 per year. That includes a lot of the taxes that an individual would typically incur, like property tax, state income tax, and maybe even state sales tax. Now, that $10,000 limitation on its own is burdensome because, especially if you're in a high income tax state, you may not be able to deduct all of your state income taxes. But that burden is really compounded in a case where an individual is an owner in a pass-through entity. So what do I mean by a pass-through entity? Well, pass-through entities are business entities, typically partnerships and S corporations, where there's no income tax or deductions at the entity level. Instead, income and losses and deductions and credits of that pass-through entity that result from carrying on business or investment activities will just pass through to the individual equity owners, who then each recognize their percent share of those items on their individual tax returns. So for example, if you had an entity with income and you had 3 partners that had an equal share, then each of those partners would report 1/3 of that income on their personal income tax returns. So, these items, including state and local taxes, are typically separately stated because there's lots of limitations at the individual taxpayer level that tie into the individual tax return. For example, with that SALT limitation, it has to be separately stated because you can only deduct up to $10,000 of state and local taxes. Similarly, things like capital gains and losses, are all separately stated because their deductibility or use and utility is determined at the individual taxpayer level. So, since the income tax of a pass-through entity is separately stated, what that means is that it's subject to the individual $10,000 limitation imposed on the owners of that pass-through entity, which they've probably already got their own personal state income taxes and property taxes, which use up some, if not all of that, and limits to an extreme extent the amount of the pass-through SALT of the entity that they can personally deduct. So in effect, what this does is it practically eliminates any ability to deduct state income taxes that are accrued on pass-through business income. So for example, let's assume we have a situation where you have A and B, who are individuals, and they're 50-50 members in an LLC called AB Ventures. Now, AB Ventures makes $1 million during the year, and it incurs state income tax of $50,000, which is paid by the LLC and not by the members on their share of income. Now, what happens is under current law, these items have to be separately stated. Each member would receive a K-1 that states that they have 50% of the income, or $500,000, and 50% of the state income tax paid, or $25,000. So in the best case, assuming that A and B don't have any personal income or property taxes payable to a state, what that means is that A and B can each only deduct $10,000 of their share of the $25,000 of separately stated state income taxes that are incurred by AB Ventures. So $15,000 of those state income taxes are not deductible. Because the state income taxes are not netted out or deducted at the entity level, they're netted out or deducted at the individual owner level. That's what separately stated means. Now, there's been lots of hand-wringing since the Tax Cuts and Jobs Act passed in terms of how do we get around this? And previously, what had gained steam were a lot of states, especially the higher tax states, looking at setting up things like charitable funds to which excess taxes would be paid and maybe credited as charitable deductions instead of being SALT deductions. And aside, that had its own challenges and limitations, which we're not really going to dive into. It wasn't a really good solution. But recently, in November, the IRS issued Notice 2020-75. And what this notice stated is that the Department of the Treasury has an intent to propose regulations under which SALT that's incurred by a pass-through entity can be non-separately stated. So what that means is that even though for federal income tax purposes there is no entity level tax that's incurred by a pass-through entity, this would allow states to impose a state income tax directly on a pass-through entity, which would make it more like a corporation. And that means that any state and local taxes paid by that pass-through entity would be netted out at the entity level, and thus would not be separately stated on the K-1s and income tax returns of the individual equity owners. So what that means is that that $10,000 individual SALT deduction cap won't apply to state and local taxes that are paid by the pass-through entities. So in our example above, with this workaround, what that means is that instead of having income of $1 million that passes through, you would have netted out that $50,000 in taxes that were paid by the entity to the state. So the entity would have had net income of $950,000 that would be divided 50-50 between A and B. And A and B wouldn't have to separately state their share of the state income tax paid by AB Ventures. So the big question is, now we have this notice, can you immediately rely on it and go ahead and start netting out your state and local taxes for pass-through entities? And the answer is no. So there's guidance coming down the pike, but for now, there's two things that might need to happen. At least one of them needs to happen, and probably both of them need to. One, all this notice does is it indicates an intent that Treasury will put regulations out for public comment, and then those will be finalized, and that usually takes up to a year for that to be finalized, if not more, and depending on the level of comment and the level of controversy. And two, states need to update their state income tax laws to directly impose income tax on pass-through entities. There's a handful of states, I think 7, that have done so far, but more states that have an income tax need to do so. And it's important to note that in states that have no state income tax to begin with, this change will likely be useless. So that has its own issues aside. It's important to note that first off, in the estate planning world, this change only applies to partnerships and S corporations. It does not apply to trusts, even though trusts are pseudo pass-through entities. So, incomplete non-grantor trust planning will still be in vogue, where you try to source income from a no-income tax state. One, to save income taxes, but two, a lot of that planning has been driven by this SALT deduction limitation of $10,000. Now, outside of that, maybe if ING trusts are no longer in vogue or too difficult, what you might start to see here, I could see this happening, is maybe a cottage industry where clients put investments into an S-corp or partnership to get around the $10,000 SALT deduction limitation. So maybe they're not changing the source of income, they're just setting up an LLC in their own state and trying to claim an entity level deduction for state income tax. So I could see that being a cottage industry in the future, and I could see the IRS digging a lot into questions of business purpose of the entity itself. In other words, does it have a substantial business purpose other than just simply saving state income tax or federal income tax? That's long been a rule, and it'll continue to be a rule, I think, even with this new regulation and this change. We'll see if the regs address that when they come out, but there will be a big question around how do you define business or investment income that would be eligible for this netting out of SALT. It's also important to note, too, that the Tax Cuts and Jobs Act will sunset in 2026. So that's less than 5 years from the publication of this video. So if nothing else happens between now and then, that deduction cap of $10,000 is going to go away starting in 2026. So will planning for this have limited utility? At least when you look at the sunset, it will. Even more, what I'd say is with a change of the makeup of the House and Senate, and a Democratic president, we're likely to see increases in tax revenue and rates due to COVID and the huge deficits that have been run. So, planning might have limited utility just because we don't know what's coming down the pike either, and we have no idea how any of those tax law changes might change SALT deductions or SALT limitations or anything like that. So you may have to take a wait-and-see approach, but the good news is, as I mentioned above, we have a runway. This isn't a final thing that you can rely on right now, and at least until it's passed at the state level. So you may be able to use it, you may not be able to, but it's worth it to check your state's income tax laws and see if this has been changed or already existed in a form that makes this deduction usable at the entity level. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.